Ascend. Wellness owes the government more in disputed back taxes than the entire company is worth on the stock market. It's a $500 million cannabis business that almost nobody covers. Here's why somebody should. Look at fiscal 2025. Ascend lost $66.8 million before taxes. Then it recorded an income tax expense of $51.4 million on top of that loss. A normal company that loses money pays nothing. Ascend pays anyway, because of a tax rule called Section 280E. The top line is shrinking. Revenue fell 10.9% in 2025 to just over $500 million, down from $562 million the year before. And here's the strange part. The company actually sold more product. Volumes went up. Prices fell faster. That's the whole cannabis sector right now. More grams, fewer dollars. So why the losses? Not the stores. On an operating basis, Ascend is healthy. Adjusted earnings of $117 million, a 23% margin, with its own brands gaining share in Illinois, Massachusetts, and New Jersey. The damage comes from two things below that line: interest on a mountain of debt and the Section 280E tax. And the tax it isn't paying in cash is piling up. Ascend stopped writing the check and started reserving for it instead. That reserve hit $218.7 million by March, growing about $15 million every quarter. The entire company is worth around $110 million. The tax problem is nearly double the market cap. Now, the debt. Ascend carries about $584 million of debt and lease obligations against just $61 million in cash. The centerpiece is $300 million of senior notes at a 12.75% interest rate, due in 2029. And interest is accelerating, up 81% year over year last quarter. Put it all together, and the balance sheet has gone underwater. Stockholders' equity is now negative, minus $76.6 million. The accumulated deficit is over $500 million. On the books, Ascend owes more than it owns. But here's what keeps it alive: cash flow. Despite a $118 million net loss, operations generated $38 million of cash, because most of that tax expense is being deferred, not paid. Ascend actually paid just $4.5 million in cash taxes. The catch: the unpaid balance is exactly that disputed reserve, and the IRS says it's owed. This is why the federal catalyst matters more for Ascend than almost any peer. If Washington broadly reschedules cannabis, the 280E tax falls away, and that $219 million reserve could reverse, swinging book equity from negative back to positive. But the April order only covered medical cannabis, and Ascend is mostly adult use. If the legal position fails instead, the bill comes due with interest. The hearing on broader rescheduling began June 29th. So what's it worth? Honestly, the stock is less an earnings story than a leveraged bet on that tax outcome. At around 50 cents, the equity is a thin sliver on top of $500 million of debt. Re-rate the business to normal consumer multiples, and the math points anywhere from near zero if 280E stays and the debt wall wins, to roughly $2 to $3 if rescheduling clears it. A wide band, and which end depends almost entirely on Washington. This is implied value under stated assumptions, not a target. So here's the framework. Bull case: broad rescheduling lifts the tax, the reserve reverses, and a cheap, cash-generating operator re-rates hard. Bear case: the debt matures, the tax bill lands, and the equity gets squeezed toward zero. It's unusually binary. We're not telling you which way it breaks. We're showing you the math on both sides. This entire analysis was built using RoboSystems, an open-source platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. You can set up the same tools I just used in about 5 minutes. Head to RoboSystems.ai to get started. Link in the description.